So Klarna, uh, Swedish buy now pay later giant. Would you say, Steve? Founded in 2005, IPO'd September, $47. The stock's like, I don't even know, it might be somewhere near $15 at the moment. It's like down 70% since its IPO highs. Essentially, what they do is they split purchases into interest free installments. You've probably seen the button when you've gone to buy your order your Greg's online or something. You can Klarna it for a few months. They've got 118 million users, Steve. They do about 3.4 million transactions daily. Some of their biggest partners are Walmart, Uber, Nike, Sephora, and H&M. But yes, they're no longer just buy now, pay later. They're pivoting. They're changing themselves up to be a digital bank. They've got cards and savings accounts and, well, pretty much a semi-full range of financial services. It's been a bit of a fintech land and expand, Steve, which we haven't seen an awful lot of. But so yeah, look, the numbers. It was their first $1 billion quarter. Revenue was just over $1 billion, up 38% year on year. The analysts wanted 1.07 billion. They did 1.082, so they beat that fairly handily. Gross merchandise volume, Steve, up to 38.7 billion. That was up about 32% year on year. If you isolate the US, it was actually up 43% year on year, which means a lot of companies are pretty saturated in the US market, so that US growth is pretty slow. But Klarna is still stretching its wings out there. US revenue alone, Steve, up 58% year on year. That's actually accelerating because in Q3 it was only up 51%, so that was pretty impressive. They've got about 15.8 million customers now converted into banking customers. That's a double. It was about 102% up. They reckon they generate 3 times as much revenue as their average buy now, pay later users as well. So it's an important metric to keep your eye on if you're interested in this stock. Credit loss provisions, Steve. It was 0.72% in Q3. It's actually come down to 0.65% of GMV. So that's nice to see that trending in the right direction. Revenue per employee, Steve, that was quite fun. 1.24 million. That's up 3.6x since 2022. Operating expenses were actually down 8% if you compared them to Q4 2022, despite revenue being up 104%. So this is a company that's trying to be operationally efficient, Steve, and trying to grow at a good rate. It's a good mix of those two things. It reminds me of kind of Airbnb, Steve, when we were looking at that back in the day. In terms of the efficiency, not in terms of Klarna going into renting houses, if that wasn't clear. So yes, revenue for the full year, Steve, $3.5 billion. Would you have guessed it was that big? I'm not sure. Up 25% year on year. Still unprofitable, but those losses are now narrowing. They said that about 11% of the US population has used Klarna in the last 12 months. And the stock was down like 7% in pre-market, Steve, but that soon became 20% down. I haven't got the market cap to hand, Steve, but if you could grab that for me, that would be great. Around 5 billion. So it was 7.15 billion prior to these earnings, I think. So yeah, pretty big. So stock got hammered. Here's why. The profitability timeline is pretty unclear. The Q3 loss was about 95 million. Credit loss provisions, obviously, of 0.72% of GMV. That was up from 0.44% a year earlier. Q4 actually improved this down to 0.65%, as I mentioned, but the market wanted this path to profit, or ideally profit, not just we're narrowing our losses. And the management keeps saying the same thing, really. There's a bit of an accounting lag. It's provisions up front. Revenue for them is going to compound over time. Fair financing, their new installment lending product, is growing fast, but it creates short-term margin pressure. The faster they grow, the worse near-term profitability looks. Now, I thought I might just explain this to you because I think it might be a little bit of something that people will get confused over. And I think the market is to some degree. But fair financing... it's an accounting trick that makes growth look like pain, is how I would explain it, Steve. But It's essentially their installment loan product. So instead of classic paying for buy now pay later, over 4 weeks or whatever. Fairer financing lets users spread purchases over 6, 12, or 24 months with interest on. And it's here because margins on that product are way better, normally because the purchase is way bigger, so they can take a bigger fee out of it. And obviously then they get interest income, which compounds over time, versus one-off transaction fees from the basic buy now, pay later product. But the accounting nightmare is kind of like this. So Klarna puts provisions for potential losses up front when the loan originates, but doesn't recognize the revenue at the same point. It recognizes the revenue over the lifetime of the loan. So when fair financing GMV explodes, i.e. it was up 244% in America, they immediately book these massive credit loss provisions while revenue trickles in monthly over the next sort of 2 years or whatever. And that makes their profitability look terrible during this growth phase, even though the unit economics for that product are actually really good. And this isn't a thing that's hurting them. It's actually helping. So the faster fairer financing grows, the worse near-term profits are going to look, but the better the long-term economics are going to become. The CFO, Nicholas Neglen, said transaction margin dollars will continue compounding as fair financing revenue matures. And I guess we'll just kind of simplify that to trust us. This is good, even though GAAP is going to make this look bad. And I think the market just doesn't trust them, Steve. I think they want to see it on the P&L, not in the CFO's explanation. And I think that's why the stock was getting murdered despite these good results. So yeah, the stock's down like 70 odd percent since IPO. It's now under 2 times trailing sales. It's cheap, but cheap doesn't matter if you're burning cash and this profitability keeps getting pushed out in this market, Steve. And I think there's that macro kind of buy now, pay later is going to get crushed if there's a big recession, if customers can't pay the bills, Klarna eats the losses, credit quality is the existential question that we're going to get faced with, when credit conditions tighten. So I've got a little bit on the banking pivot, Steve, and then I'll probably pass to you, and then I've got a little bit more afterwards. But the CEO said that they've been basically executing on this clear plan. They're acquiring customers through this seamless payments sort of thing they have, and then they deepen those relationships by offering banking. So essentially, get users in via buy now, pay later, then cross-sell them bank accounts and cards and savings. The banking consumers generate about 3 times the revenue, and the Klarna card has about 4 million signups just in Q4 alone. So it's smart long term, Steve. Buy now, pay later alone is commoditized. Every bank offers it now. Maybe a weak network effect moat, Steve. Maybe you could say. But a full digital bank, Steve, with checking, savings, cards, investments, I think that's a bit stickier. Higher lifetime value, definitely. Recurring revenue instead of transactional revenue, that's pretty good. But in the short term, it's pretty messy because when you're building a bank, you need capital reserves, which is expensive, regulatory compliance, which is expensive, especially for somebody who's moving from not being a bank to a bank. There's a big build-up required in staff and experience, and that doesn't come cheap. And obviously then there's customer acquisition for the newer products as well, which, can be expensive, but I think Klarna have a way of bringing this down a little bit. So while they're investing in this growth, those margins are only going to compress. And in this kind of market, that's not going to go down well, Steve. This market wants to see profitability. It wants to see you going towards profitability. It wants to see how you're going to deal with AI. And at the moment, Klarna can't really offer that. On the face of it, I think people who are willing to look a bit deeper, Steve, might find their answer. But what do you think?
I think you're exactly right about this being a macro-related worry, and investors in this kind of environment, we're thinking K-shaped economy in the US, where whether it's actually just, until very recently anyway, whether it's the stock market or consumers, the big and high-powered and wealthy are doing pretty well and getting better, and everything else is getting crushed. And that's the general fear going around at the moment. And I think a lot of people are looking for signs of this to kind of confirm what they're already thinking. The problem with aggregated data, which you get in terms of how the US consumer is doing, is that it hides this quite well. So some wealthy person buys a fancy car, and that covers quite a lot of people not being able to buy food in terms of aggregate consumer spending. So they're looking at things like Klarna, and they're looking at how many people are using buy now, pay later, and you say that's up to 11% of the population. And I think if you're looking for concerns, you will see that as a concern. And if you're not looking for concerns, you won't see that as a concern. If you're wanting to see Klarna spreading itself out into more people's lives because it's a buy now, pay later product and it's got a large target market that it ought to be trying to get to, and it is, you will see that positively. If you think that's because people, or if you're wanting to see signs that people can't currently afford the things that they're trying to buy, you will also see it as that. But if you also read an unhelpful headline that says Klarna reports massive loss, you will also see, oh dear, this is not good, especially if you think that loss is to do with bad loans and loan provisions one way or another. And you will also think that is not good. But this is to your point about revenue recognition then, in that case. And revenue recognition has been very much our theme of 2026. I think probably last year's it was something like same-store sales. But this year is about revenue recognition and the fact that companies, when they shift over or either shift over in how they record their revenue or recognize revenue generally, or end up with a growing product where they recognize revenue basically in a sort of straight line rather than all up front, or spread over the life of the product rather than all up front, then their revenues come in light. But the thing is, they keep getting revenues coming in and they don't have any increasing costs in the next few, however many it is, quarters or months or whatever the kind of scope of the Klarna thing is, as long as those loans don't go bad. So the market, I think, as you're right there in saying, is looking to disbelieve them for whatever reason. That's not particularly helpful, but that would be my sense as to why it's down 27%. I'm interested in the banking pivot. You kind of bring people in via buy now, pay later, and then convert them into a savings account or a current account or whatever. It's sort of like a reverse Monzo, really, which kind of brought people in via a banking app. Well, initially via a card and then via a banking app. And then started selling them buy now, pay later flex things. And I use my Monzo Flex quite a bit and spread things out over 3 months. They haven't yet managed to collect anything out of me in interest payments, but it does encourage me to use my card and keep my cash somewhere else where it's earning money. That becomes less attractive the longer, the more my interest rates keep falling, and all my Monzo pots appear to be collecting lower interest rates because Shawbrook or whoever has decided to cut the rates on their savings accounts. But yeah, very, I don't want to say certain, but very high chance of an overreaction here with a 27, I think, percent decline as I'm looking at this. If you bought the thing at its IPO, you would have about a third of your money left from that investment. I'm happy with the idea at IPO too high, but as you point out, if it keeps growing revenues at whatever it is, 38% at the moment year over year, we're going to pretty soon be trading at a negative, well, not a negative, a price to sales of below 1, which is pretty cheap as long as things are holding up okay. And at the moment, it seems like they are. The thing is with these, are always all right until they're not, but for the moment, they're still in the all right category, I think.
So here's something interesting for you, Steve. So they make the headline is that they make a huge loss on their lending at Klarna. Realized losses on Klarna's lending division, Steve. So they make provision of about 0.72, but realized losses, the actual losses they make is 0.44%. Compare that to a bank at the moment, Steve. 0.72 was last quarter at the US banks. 0.66 was the most recent quarter on US banks on all of their lending. So Klarna's actually a little bit better at lending in this way, and it is worth noting that they've been underwriting these loans and refining this technology for 20 years, Steve. They've loaned out $500 billion in volume. This isn't a small company. They know how to manage this risk. And I think the analysts do actually see this, Steve. There's 13 analysts at the moment that rate it as a buy. There's actually 0 that rate it as a sell. And I think there's that kind of US revenue growth up 58% year on year. 11% of Americans use Klarna in the last 12 months, as I said. Buy now, pay later is growing about between sort of 8 and 10% annually in the US, and Klarna's taken its fair share of that. if they become this default buy now, pay later plus neobank for Gen Z millennials, this could quite easily be a sort of 40-50 billion dollar company in 5 years, Steve. The upside from here, if they can pull this off, is pretty incredible, I think. I'll just give you some quick highlights on the call as well, Steve, because the call was super bullish. The market didn't seem to buy it, sent it down further off the back of the call. But so I mentioned earlier, but what the CFO said, that the fair financial revenue is going to compound. But the problem was that he wouldn't commit to a specific quarter for profitability. I think the market wanted a date. They talked a little bit about their sort of AI efficiency. This is where I got the revenue per employee stat from. So that's $1.24 million per employee. Headcount has actually declined about 49% at Klarna. And that's because they're using AI, their own model for customer service. It does underwriting and it does fraud detection as well. So OPEX was actually down 8% while revenue was up 104% since, 2022. So impressive, I thought there, Steve. They talked a lot about how banking consumers has essentially doubled to 15.8 million. They generate 3 times the revenue. This is definitely the future for them. Fair financing gross merchandise volume was up 244% in the US, which to me, Steve, says they're really winning market share in a big rate. They asked about rising provisions, and management pointed to the 0.65% provision rate in Q4, which is actually down, and said underwriting is working, delinquencies are improving. So that's pretty good. The management were really confident, Steve. The market wanted proof, not promises, but they've always been saying this kind of, they're a little bit like, next quarter will probably look a little better. Next quarter will look a little bit better. And I think they probably weren't just quite ready for the public market, Steve, when they came and IPO'd. I think they needed to be a little bit further down the line, but I think they've realized really quickly this transition. And I think I think they're doing really well at the moment. So yeah, I think the sentiment on Klarna is really bearish at the moment, and they seem to think buy now, pay later is pretty dead. But I wonder, Steve, if we're getting close to sort of peak pessimism here. I don't see justified skepticism. I think my read on the business is it's doing rather well. The revenue growth is great. The improving credit metrics is great. Explosive US traction is great. The banking pivot makes sense in my head. Yeah, the lack of profitability visibility is a bit of a red flag, Steve. But if you can't turn profitable with $4 billion in revenue and AI running all your back end, when can you? And I think the answer will be when that growth starts to slow in their lending division. So yeah, I'm a holder of this stock. It's a very small part of my portfolio. It gets smaller every day, but I could definitely see myself buying here, Steve. I think they've got this margin expansion on the way. I think if I was to adjust my model to this, you would see there's a clear path to profitability. They're almost there. So yeah, I think under 2 times sales, it's got to be the cheapest high growth fintech on the market. I can't think of any that are in this kind of range. So yeah, I think it feels to me like it could be a steal, but I guess time will tell. And I think Klarna, if I was to summarize it, I would say it's a company doing almost everything right, but they can't make money and it's trading like it's going bankrupt, which I guess is just kind of like welcome to investing in sassy fintechy stuff in 2026, Steve.
I can't see any reason why anyone who had been buying this stock previously, pretty much any time previously since it IPO'd, would not now be at least thinking of buying it. I mean, it's at least possible in my head that something else has fallen even faster recently, and now you think that thing's a better buy than Klarna is here. That could be the case. Not sure what I think that would be exactly, but I'm open to that thought. I don't see anything, put this way, I don't see anything in the results that's thesis changing for anyone who owns this thing, and it's now cheaper. Quite significantly cheaper than it was pretty much any time when you bought it before today. So I see your thought here of you were a buyer. If you were a buyer at any time before, it doesn't really matter when. I mean, if you're a buyer at the IPO, I would be, if I bought this thing at the IPO, I think I would be trying to aggressively average down because I'd be worried about getting taken private at a price below the IPO at these levels. I'm not exactly sure who I think a buyer might be for this per se, But that would be my only real concern at the moment. If I'd seen my way into buying this before, I can't see how I wouldn't be buying it now unless something dramatic had happened elsewhere in the market, which is possible from my perspective. If you think that drop on Amazon recently meant actually, you know what, I'm going to go buy that instead, or I would understand that. I can't see anyone saying, yeah, okay, hang on, I've had another look at Klarna and now I don't think it's worth it. I thought it was worth it. 40% higher than it currently is, but this has all gone wrong rapidly. It hasn't all gone rapidly wrong. The stock market is acting as though something big has changed, and if something big has changed, it's changed outside the company, and it's not obvious to me what that would be, is what I think I take from this set of results. So the other point, as you point out, is that anyone who bought this before, it's now almost certainly a smaller part of their portfolio than it was. So even from a diversification perspective, you've probably got room, nearly anybody, to take it back up to whatever your initial allocation to the thing was. If it was 5% and now it's 4.1% of your portfolio, you can probably buy another 20% of your current investment or so to get yourself back to there again without too much bother. I mean, this kind of thing is fun until it's not, but don't worry, I've got the same thing going on with Celebros, but I can't buy that anymore because I own too many shares for Trading 212's liking.
I mean, just hypothetically, Steve, if you you had a Sleeping Beauty moment and you fell asleep, and 10 years later you woke up and you felt compelled to check the Klarna stock price as your first thing that you did, and you loaded it up and it was 50 billion, let's say, in market cap, and we're at 5 now. Would you be shocked looking at these numbers today and the last time we covered it? Because I don't think I would, Steve. I think this could quite easily be a 10 bagger from here. I think it's literally being profitable away from complete market sentimentality changing here. And the thing is when it becomes profitable, it won't be like when we forced Salesforce to do it by kicking Matthew McConaughey off the board. It'll be like it will be profitable and the growth will likely still be there, because this isn't the thing where it's going to go, okay, you want to see money, we'll have to turn these growth taps off and we'll sort this problem out and we'll cut these headcounts here out of the sales staff. Klarna doesn't have to do that. It just has to let these things happen naturally on the road. What you're kind of seeing is somebody setting up a bank at breakneck speed with massive demand and then saying, well, why aren't you profitable? And you say, well, because I'm setting up a bank at breakneck speed and there's massive demand for my products. And the way you make me account for it makes me look like I'm not profitable. I mean, we're seriously saying that Klarna has been going for 20 years and has lent $500 billion in loans and hasn't gone bust because it's a terrible lender. That's evidently not the case. You can see that's not the case by just the fact that they've survived 20 years and loaned out $500 billion in volume. They're evidently okay at this lending stuff, and they probably have got better over a period of time. But yeah, this is a company, Steve, that I think has massive upside here. I think it has absolutely massive upside. I would be shocked if this isn't up in 10 years' time for me, Steve, in a good way.
Swedish banks, man. Swedish banks are good at lending. They don't make massive losses. Handelsbanken was similar, right? Didn't make massive losses during the GFC. Well, if you're interested in investing like us or learning about how we find stocks to buy, you should check out our Substack. For the next few weeks, we're releasing 10 pieces, one every Saturday morning, that will tell you about how we hunt for quality companies and avoid overpaying for them. On the subject of not overpaying for things, the pieces are free. Obviously. It's led by Steve D, who has spent a lot of time talking to investors, answering questions on stocks and where to find opportunities as share prices shift around. But I'll be taking a look as well and adding in bits and pieces along the way. We'll also be talking about some of our favourite books, and we'll have Amazon links set up so you can buy these if you want to. We do get a kickback if you buy through there, but you don't have to do that. You can also use our link to buy us a coffee, but you don't have to do that either. We don't even want your email address. It's that free, and by the end of it, you'll have our complete guide to researching stocks. You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.